If you're learning how to invest in stocks, one of the most useful skills you can learn is how to read an income statement. An income statement, also known as a profit and loss statement or P&L, shows you a company's revenue, expenses and profit and helps answer one of the first questions investors ask when analyzing a business. Is this company actually making money? In the next 10 minutes, we'll read an income statement from top to bottom, explain terms like revenue, gross profit, operating income, net income, and earnings per share, and show you what those numbers can tell you about a business. And we'll do it using a company most people already understand, Costco. This video is for educational purposes only and is not financial advice. Always do your own research and consider your personal circumstances before making investment decisions. Before we start reading one, let's clear up something that can make this more confusing than it needs to be. You may hear this document called an income statement, a profit and loss statement, or simply a P&L. These are different names for essentially the same financial statement. You'll also see income statement information included in a company's quarterly or annual earnings reports. The income statement shows what happened financially over a period of time, perhaps 3 months or a full year. And the basic idea is remarkably simple. A company earns revenue. It subtracts the costs of generating that revenue. Then it subtracts the other costs of running the business. What's left eventually becomes profit, or if things haven't gone so well, a loss. Rather than looking at a page full of unfamiliar numbers, we're going to use Costco as our example. Costco is useful because the basic business model is easy to understand. Customers buy products from its warehouses, and members also pay membership fees. We're going to simplify and round the numbers considerably so we can concentrate on learning how an income statement works. So if you look up Costco's actual financial statements, don't expect the numbers in this example to match. We're learning how to read the document. We're not analyzing Costco as an investment. Let's start at the very top of our income statement. Imagine Costco reports $250 billion in revenue. Revenue, sometimes called sales, is the money the business generated before its expenses are deducted. This is often called the top line, simply because it appears near the top of the income statement. But here's the important part. Revenue is not profit. If Costco sells you something for $100, it hasn't necessarily made $100. Costco first had to buy or produce the product it sold you. So our next question is, what did it cost Costco to generate those sales? Next, we come to cost of goods sold, often abbreviated to COGS. For a retailer like Costco, this largely represents the cost of the merchandise it sells. Let's simplify that to $220 billion. So we started with $250 billion in revenue. Subtract $220 billion in cost of goods sold. That leaves us with $30 billion, and that number has a name, gross profit. Gross profit also helps us calculate something called the gross margin. In our example, Costco has $30 billion left from $250 billion of revenue after paying for the goods it sold. But percentages can make that much easier to understand. Imagine Costco generates $100 in revenue with a gross margin of around 12%. About $12 remains as gross profit after the cost of those goods has been deducted. That makes gross margin useful when comparing companies of different sizes or when looking at the same company over several years. If revenue is increasing but the gross margin is falling, the company may be selling more while keeping less from each sale. We're not finished subtracting costs yet. Costco still has to operate the business. There are employee costs, utilities, administration, technology, marketing, and many other expenses involved in running a huge company. These are generally reflected in operating expenses. Let's say our simplified operating expenses total $20 billion. Subtract those from our $30 billion gross profit and we're left with $10 billion in operating income. Operating income is particularly useful because it gives us an indication of how profitable the company's core business operations are. We started with everything Costco sold. We deducted the cost of those products. Then we deducted the expenses required to operate the business. And now we're getting much closer to the actual profit. But we're not quite at the bottom of the income statement yet. There can still be interest, taxes, and other non-operating items to account for. Let's say interest, taxes, and other items reduce our $10 billion operating income by another $3 billion. We're left with $7 billion in net income. This is why you'll often hear investors talking about a company's top line and bottom line. Revenue is the top line. Net income is the bottom line. Net income is what remains after the company's expenses and other relevant costs have been accounted for. And if that number is negative, the company has recorded a net loss rather than a net profit. There's another number you'll commonly find near the bottom of an income statement: earnings per share, or EPS. Net income tells us how much profit the company generated overall. EPS relates those earnings to the company's shares. In simple terms, if a company earned $7 billion and had 1.4 billion shares outstanding, that would equal approximately $5 of earnings per share. EPS becomes particularly useful when we start looking at company valuation and measures such as the price-to-earnings ratio, which we'll cover separately. For now, just remember, net income tells us the company's overall earnings. EPS expresses earnings on a per-share basis. Now we come to one of the most important parts of actually using an income statement. Don't just look at 1 year's numbers, compare them. Is revenue increasing? Is gross profit increasing? Are operating expenses rising faster than sales? Are profit margins improving or shrinking? And is net income moving in the same direction as revenue? One income statement gives you a snapshot of performance over one period. Several years can reveal a trend, and trends are often much more useful to an investor than a single impressive number. There's one more important point. An income statement can tell us whether a company is profitable, but it cannot tell us everything about the company's financial health. It doesn't give us the complete picture of how much debt the company has. It doesn't show everything the company owns. And accounting profit isn't necessarily the same thing as cash flowing into the business. That's why investors also use the balance sheet and the cash flow statement. Think of the three statements as different views of the same company. The income statement asks, is the business profitable? The balance sheet asks, what does the business own and owe? And the cash flow statement asks, where is the cash actually coming from and going to? So when you open an income statement, don't be intimidated by the page full of numbers. Read it from top to bottom. Start with revenue. Subtract the cost of goods sold to reach gross profit. Then look at operating expenses and operating income. Continue down through interest, taxes, and other items until you reach net income, the bottom line. Then look at earnings per share and, importantly, compare those numbers across several periods. You don't need to be an accountant. You just need to understand the story the numbers are telling you. The income statement tells us whether a company is making money, but that's only one part of the story. In the next video, we'll look at the balance sheet and learn how to see what a company owns, what it owes, and how financially strong the business may be. If you're finding these simple investing lessons useful, please subscribe to the channel. It costs you nothing, but it really helps the channel grow.